Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the November investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the market and investment universe that you need to know right now. Bob, has the government shutdown got you shut down, or are you able to comment on how things are going?
No, I'm able to comment for sure. It's been a good market environment overall this year, and largely I'd say the market has shrugged off the shutdown. But what is interesting is we're now into the longest government shutdown in history, so it is a little unprecedented territory. So, we don't know what could happen from here. There's really no history to look at, but the history we have looked at has said that it's not a big deal, and that's how the market's reacted.
Last time we had a shutdown, you shared with us your clock website that you look at. So that has not been active?
It's actually funny. Yeah, time.gov, back when I used to have not an Apple Watch, I was a stickler with getting the time right to the second. So I go to time.gov to get the time right. And we had daylight savings time over the weekend. And I went to time.gov to get the microwave and the kitchen stove right. And time.gov was working. It still exists. And I got the time right. So even that didn't get shut down yet.
So I'm at Schwab's Impact Conference, which for those of you who don't know is basically their largest independent financial advisor conference. Their big thing is, I think there's like 5,000 to 10,000 people here. In the opening night presentation, they did talk about the shutdown and just shared that, pressure points are increasing with federal workers not getting paid. SNAP for 42 million Americans. Is it going to be paid partially or fully? The lack of data being an issue. But the biggest thing they said is the airports, the sick outs, and the potential to have to shut down airspaces next week, very close to Thanksgiving, is probably going to be the catalyst to get this to reopen, I guess, in essence. And that you basically need 6 senators on each side to carve out an agreement, and they've started meeting, and that the contours of the agreement would be obviously to reopen, to find a new temporary date to keep funding the government, maybe to mid-January, an agreement to take up the actual appropriations program, vote on the expiring Affordable Care Act subsidies. And what they said, which was interesting, is if they don't recess later this week, get the sense that we're closer to a deal. So that's just one thing to watch. By the time this records, we'll know if they've recessed or not. Not record, sorry, publishes. So anyway, moving on from that, there's been a lot of talk about, the valuations, particularly in the big tech US market, and a lot of the advice to counterbalance that, which we've shared, is to diversify globally. And, I asked you to kind of look at, well, what would that change your portfolio to, right? If you were a US-centric investor, you own the S&P 500, US large cap, and you followed the advice to diversify globally, and you went to the global stock market index, the MSCI ACWI, given how huge those US large cap names are, the NVIDIAs, of the world, and the fact that the MSCI ACWI is also market cap weighted, how much diversification are you getting going to a global stock portfolio when the US has the behemoths, basically?
Yeah, it's a good question and an interesting exercise. So what you get is like the top holdings look very similar by name, but the weight is lower in the ACWI. So for example, NVIDIA is the top holding in the S&P 500. It's about 8.6% of the S&P 500 in just NVIDIA, which is pretty high. If you look at the MSCI ACWI, NVIDIA is also the top holding, but its weight is more like 5.3%. So it's not miles off, but I'd probably prefer 5% in it than 8%. 8% seems like a high number. But just looking at the top 10 holdings of the ACWI, I'll read them off in order from largest to smallest. NVIDIA, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, Alphabet Class C, Tesla, and Taiwan Semiconductor. So the first nine are all US companies. Those are the top nine in the S&P. And then you get Taiwan Semi at 1.3%. And if you go layers deeper, I won't read off the top, going to 20 and 30, but it's really dominated by US companies, all familiar names. In fact, Tencent is the only one on the second page of 10, 11 through 20. Tencent, a Chinese tech company. And then going deeper, you have ASML, a European semiconductor company, and Alibaba and Samsung. Otherwise, you're looking at US companies just in lower weights. So the ACWI has more names in it and you get more diversification, but it's still dominated by US tech just to a lesser degree than the S&P 500.
Do you have a sense of the tech sector, exposure from ACWI to the S&P?
Yes, so the ACWI is total tech is 29% approximately, and the S&P is 37%.
Okay. So, I mean, what's going on here is impacting the weightings of global markets, but is it sensible then to invest in an ACWI type portfolio because you're taking a little bit off the table, so to speak, but you're still, exposed to these themes that investors appear to love?
I think the number one reason to invest globally is for diversification, and you get it in many ways. By hold and count, you get more holdings, more diversification. I'd say better sector balances, so not 37% in one sector. So that's another reason. And then geographical diversification, currency diversification. So it checks all the boxes in that area.
And the ACWI is outperforming the S&P this year.
It is, yes.
Yeah. So we usually start with that, Bob. How are markets doing?
Yeah, looking year to date, the MSCI USA, which is similar to the S&P US large cap stocks, is up 16.1%, so a strong return. Looking overseas, the MSCI World ex USA, so developed international markets, is up 25.7%. So that's about 9% better than the US market. And then emerging markets, the MSCI Emerging Markets Index is up 32.1%. So about double the US market there. So strong returns from overseas markets being led by emerging. And then looking at fixed income, the Bloomberg US Aggregate Bond Index is up 6.8%, which is a quite
Wow.
strong return for US
Yeah.
investment grade bonds. It does pale in comparison to what stocks are doing, so no one's getting too excited about it. But us investment nerds are mildly impressed with a 6.8% return from the ag this year. So really, markets are firing on all cylinders this year. It's been a good year to be an investor.
And that's, kind of a recap of where we've been. You and our director of portfolio management, Michael Waldron, recently did a market outlook webinar. It's, I think, our most popular event of the year. And for those who weren't able to listen or just want to hear maybe a more concise recap, what are some of your takeaways from that outlook that you want to share with our listeners?
Yeah, the lightning round outlook. So I just read off the returns, and foreign markets are doing better than US. Why? A good part of the foreign outperformance is from dollar weakening. So to the tune of about 12% that the dollar has declined relative to a basket of foreign currencies. And that when you own foreign equities in the local market, local currency, a dollar weakening leads to price appreciation and vice versa, of course. So a good chunk of that foreign outperformance has come from the dollar getting weaker. So we talked about that, the government shutdown and how we were approaching the longest shutdown in history, with historical data showing that prior shutdowns were mostly non-events for markets. Markets went up for the most part during recent shutdowns, and it seems like that's been the case. But I would put the asterisk that now that we're, the longest one in history, as you led off, as you go deeper, you would expect with less money, to be there to spend, the cuts to increase, and it could get more severe. So we don't know where we're going from here, but historically it's been good. And then we switched to Fed policy. So looking at economic data, The unemployment rate has been ticking up from 3.5% up to 4.3. So the overall level of unemployment at 4.3 is relatively low, but the direction being that it's been increasing is concerning, whereas inflation has been on the decline. It was high single digits and now it's in the high twos. And it's stable on the high twos, so it's not perfect. It's not exactly where the Fed would like it at 2.0, but at least it's stable, whereas unemployment is not looking stable. It's been climbing, and that's why we've been seeing Fed rate cuts. And we recently had one, and it looks like there might be another one later this year. So the Fed is easing, which, there's a Wall Street saying don't fight the Fed. So the Fed is you could say providing a tailwind to financial markets right now as they're easing while they're still strengthening the economy, despite what's looking like a weakening labor market. And then we touched on valuation specifically in U.S. equities, which is the one cautionary note that looking at the S&P 500, the price to earnings ratio is on the higher end. At the end of the quarter, forward PE was 22.8, and the last time we were at that level, I believe, was back around the tech bubble in 2000, the late 90s to early 2000 period. So we are seeing elevated valuations, but are they justified? And I think it really comes down to AI and that leading to higher productivity. And think of higher productivity as companies being more efficient, larger profit margins, greater corporate earnings. So if that all plays out, then you can justify higher earnings, which is higher multiples, which is what we're seeing. So that's the quick run through.
So it doesn't sound like you're overly concerned with valuations, and you're just more expressing a cautionary tale of diversification, which is what we started the conversation with.
Yeah, I mean, they are on the high end, and foreign markets aren't up there. So it is, we certainly do support diversify globally. Don't get over your skis. I think I've said that half a dozen times on this podcast. And a common end investor question I get is someone will look at, say, two investments and look at the historical returns. And if one has returned, call it 15%, the other one's done 8, they'll mentally think, well, this is a 15% annual return vehicle, and this is an 8, so the 15 is better than the 8, so I'm going to own the one that does 15, like it's the speed of a horse or a car or something like that. And that's just not how financial markets work. The 15 can turn into the 8, and the 8 can turn into the 15. And the U.S. market has done well. It's been strong. Multiples have expanded, which is how one of the ways that you can get really strong returns. I wouldn't count on future multiple expansion from here. It could happen, but then, there's very little historical precedent for it to go up much more. So just for context, the forward PE at 22.8 in the tech bubble, it peaked around 24 and change, and it didn't get up to 25. So to have the highest forward PE in history, you can see multiple expansion of less than 10%. But if you put that as the ceiling, so the valuations are high, and I would not count on these teen-like returns out of the U.S. market, at least in the next couple years from here without a big correction.
We hear the phrase with growth stocks, when they get into lofty valuations, that they're priced for perfection, which basically means, well, I'll see if you concur, that it means that if the earnings start disappointing, then, these stocks could take a tumble because of what the market has expected for them. So I saw a research report from Goldman Sachs, which was basically saying that the biggest risk is earnings momentum and, watching whether these names kind of keep delivering the earnings growth that the market expects and has priced into their lofty valuations.
Yeah, that's well said, priced for perfection. A different way of framing it is the earnings multiple reflects expectations about the future. And when the earnings multiple is high, it's expecting great things in the future. When it's low, it's expecting bad things in the future. And as I've said here before, it's not good or bad, it's better or worse. And when you're priced high and expecting great things of the future, to go higher, you have to really exceed those already lofty expectations, whereas to go lower, You just have to come a little under great, which could still be good, but that the market's expecting higher than that. So it's price for perfection is a good way of putting it. That I think there's a lot of room on the downside if we don't see, strong increases in earnings and good economic growth and AI delivering, across the board as expected.
So let's take a step back and look maybe more longer term. JP Morgan recently came out with I think their 10-year capital market assumptions. We use our own capital market assumptions, but we're big believers in, the importance of having that information and those guideposts as you build out your asset allocation. And I believe we both respect JP Morgan and their methodology, and that we've used their research before. What jumped out at you as you looked at, their capital market forecasts?
Yeah, they put out a good report. It's, I think, close to 90 pages. They have a deep team that works on it. The report comes out once a year, and they do a good job. I think they've been doing it for over 30 years. So it's something we've looked at for many years now. And when it comes out, it's always a, interesting read to see what they say. Um, that being said, there weren't a lot of surprises or changes year over year, and that is kind of the nature of capital market assumptions being long term, that you don't see huge changes year over year. So just maybe reading off a couple of the key numbers. So for bonds, like U.S. intermediate term treasuries, they're looking at 4% annualized. Long-term treasuries 4.9. U.S. aggregate bonds, that's probably the line item to highlight for just broad U.S. bonds, 4.8%, which is an increase from 4.6% last year. So last year they were saying over the next 10, we're looking at 4.6. Now they're saying 4.8. And behind the scenes, they're expecting interest rates to either remain steady or decline, which would be a tailwind for bonds. So that I think explains, along with slightly elevated yields, the higher returns of 4.8 from bonds. Then looking at equities, U.S. large cap 6.7% annualized. So a pretty low return. That's exactly the same as what they said last year, 6.7%. So unchanged on U.S. large cap. Looking at other markets like EFA equity, so that's developed international, Europe, Asia, Far East, 7.5%. So about, what's that, 80 basis points higher return from developed international equities. And then emerging market equity, 7.8%. So a little bit higher from emerging markets compared to developed internationally and compared to US. So 6.7 on the low end to 7.8 on the high end for equities. So decent returns, but like I was saying, I don't know, 5 minutes ago, not what we've lived the last 3 years. So setting expectations for lower returns, still, acceptable for most people, most financial plans to work, but not double-digit returns. But these are annualized over 10 years, so you'll still see some highs and lows, but that's where they're putting the average to come in.
So, Bob, how do they do the fixed income returns? Because we talk a lot, or we've talked a lot, and we read and hear a lot about concerns with debt and deficits, rising rates. Eventually, will the bond market react negatively to what's going on fiscally here in the U.S.? And does that factor into their 10-year projection for fixed income? To kind of increase bond yields and assume rates will come down a little bit. Does that surprise you, or is that just a separate analysis and it's just not part of the investment thesis?
Yeah, yes and no. So I don't believe it should be considered as part of fixed income, but their view is that rates will decline a little bit, or stay somewhere between stay the same and decline. So they probably average it out to a slight decline, which we're seeing rate cuts. And you hear what President Trump says about Fed policy and what he'd like to see. And with Powell's term being up next year, expecting a more accommodative Fed, I think is reasonable. So that's on the fixed income side, where I think what you're bringing up plays in is with foreign equities. So why do international equities have a higher expected return than US equities in their modeling? And they are assuming dollar weakening over the next decade. And that's a question that I've received from clients a few times after talking about how part of the tailwind that we've seen in foreign equities this year is from a weaker dollar. But the follow-up is that going to continue? What do you think about that? Or did I kind of miss it? They're expecting it to continue. I like to quote the dollar euro because I just think a lot of people are familiar with the euro, have traveled to Europe. And when this report was published, I think it was the end of the third quarter, it was $1.16 to buy a euro. It started the year at about $1.01, so close to dollar euro parity. And they're expecting the long-term kind of equilibrium is about $1.25, $1.25 from $1.16. So that's showing dollar weakening is their projection, which is strength for European equities. And one reason behind that, why you would say, why would the dollar weaken? That could be tied to the US not having its fiscal house in order.
Okay. Well, I appreciate that, Bob. Anything else as we head into year end that you or your team are looking at?
No, I think we pretty much covered it. This is what we're looking at. We're going to be running our own capital market assumptions with our partner Fiducian and looking at portfolio changes resulting from that.
Great. Well, I appreciate the insight as always, Bob. I know the listeners love hearing from a chief investment officer of a big firm, and so I appreciate your time.
Thanks, Amy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kushal Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.